Somewhere in the world right now, someone is telling themselves the same lie most of us believed at least once. I'll start investing when I have more money, when I get the raise, when I pay off my debt, when life is more stable. But what if I told you a man once started with just $5 a day? Not 5,000, not even 500, 5. And 30 years later, the number in his account made people question everything they thought they knew about money. The strange part? The story isn't about being smart, it's about doing something so small most people never take it seriously. And that tiny decision quietly changed his entire life. But before we get to the ending, there's something you need to see first, because this story might be about you more than you think. Imagine being 25 years old. You just got your first real job. Your salary is around $40,000 a year. After taxes, rent, groceries, transportation, and the occasional night out, your bank account isn't exactly impressive. Maybe $300 left at the end of the month. Some months, nothing. You open social media and see people talking about investing, stocks, crypto, real estate, index funds. But something inside you says the same thing most beginners feel. I don't have enough money to invest. Because in our minds, investing looks like something rich people do. You picture someone moving $10,000 at a time, or buying entire properties, or building giant portfolios. So $5? $5 feels pointless. It feels almost embarrassing. But this story begins in 1993 with a man who ignored that feeling. His name isn't important. He wasn't a finance expert. He wasn't a hedge fund manager. He worked a normal job, making about $38,000 a year. Pretty average. But he noticed something about his spending. Every day he bought small things: coffee, snacks, convenience store drinks, small purchases that felt harmless, about $5 a day. Not enough to feel painful, but enough to quietly disappear. So one day he made a strange rule. Instead of spending that $5, he would invest it. Every day, no matter what, rain or shine, market up or down. $5. That's it. Now, pause for a second. Seriously, think about this. $5. Most people spend that without noticing. Coffee, energy drink, app subscription, a random online purchase. We treat $5 like it's invisible. But here's the question most people never ask. What happens if that invisible money starts working? Let's run the math. $5 per day is about $150 per month. Over 1 year, that's $1,825. After 10 years, he contributed about $18,250. Most people stop there and think, that's not life-changing. And they're right, because the real magic wasn't the money he put in. It was time. He invested that money into simple index funds, nothing fancy, just the type of funds that track the overall stock market. Historically, the stock market has averaged roughly 10% per year over long periods. Not every year. Some years crash, some years explode. But over decades, the average has hovered around that number. And this is where things get interesting, because compounding doesn't behave the way our brains expect. Human brains are terrible at understanding exponential growth. We think linearly. If we save $1,000 a year for 30 years, we assume we'll have about $30,000. But compounding doesn't grow in straight lines. It grows like a snowball rolling down a hill. Slow, then faster, then suddenly unstoppable. So this man kept investing $5 a day, year after year. He didn't stop during market crashes. He didn't panic during recessions. He didn't try to time the market. Just $5 every single day. Then something happened. The year 2000, the dot-com crash. The market collapsed. Stocks fell everywhere. People panicked. Many investors lost 40 to 60% of their portfolios. Some quit investing completely. But remember his rule: $5 every day. So while everyone else was selling, he kept buying. And because prices were lower, he was actually buying more shares. That detail means more than you think, because when markets recover, those extra shares multiply the rebound. This is one of the most powerful but misunderstood investing principles. Market crashes are painful, but they are also opportunities. Fast forward a few years, the market recovered. His portfolio grew again. But then came something worse. 2008, the global financial crisis. Banks collapsed, the housing market crashed, millions of people lost jobs, the stock market dropped about 50%, half. Imagine opening your investment account and seeing half your money gone. Most people would stop. Many did. But remember his rule: $5 every day. He didn't increase it. He didn't decrease it. He just stayed consistent. And over time, something remarkable happened. After 10 years, his portfolio wasn't $18,000. It was closer to $30,000. After 15 years, it crossed $60,000. After 20 years, it reached about $120,000. Now here's the part most people underestimate: the final 10 years, years 20 to 30, because compounding becomes explosive late in the game. Those last 10 years turned his account from about $120,000 into roughly $350,000 to $400,000, depending on market conditions, all from $5 a day. Total money he personally invested over 30 years, about $54,750. But his account grew to several $100,000. That difference is the power of time. Now, pause again, because this is where the story becomes uncomfortable. Not inspiring, uncomfortable, because millions of people had the same opportunity, but they didn't take it. Why? Because of something psychologists call present bias. We naturally prioritize rewards right now over rewards in the future. Your brain says, coffee today feels real. Money 30 years from now feels imaginary. So we choose the coffee again and again without realizing the hidden cost. And that hidden cost can be enormous. Let's change one number in this story. Instead of $5 a day, what if it was $10? That's about $300 per month. Over 30 years at a 10% average return, that could grow to roughly $650,000 to $700,000. Now imagine $20 per day, about $600 per month. Over 30 years, you're approaching $1.3 million. Not from winning the lottery, not from risky trading, just consistency and time. But here's the twist most beginners don't expect. The hardest part isn't the money, it's the first year. The first year feels pointless. Your account might only grow a few $100s. You check it and think, that's it? So most people quit. But the first year isn't where compounding shines. The first year is where discipline is built, and discipline is what allows compounding to work later. Because investing success rarely comes from brilliance, it comes from not quitting. Look at the real numbers behind millionaires. Studies of long-term investors show something surprising. Many millionaires didn't start rich, they started early. Even small amounts. Many simply invested consistently in index funds inside retirement accounts. Over 20 to 40 years, the math quietly did the heavy lifting. And here's the beautiful part. You don't need to predict the next hot stock. You don't need to trade every day. You don't need to be a financial genius. You just need three things: consistency, time, and patience during chaos. But there's still one more part of the story, the part that surprised even him. After 30 years, the money wasn't the most important result. What actually changed was his behavior, because investing daily trained his brain to think differently. He started asking new questions. Instead of "what can I buy today?" he asked, "what can I invest today?" Instead of chasing quick wins, he focused on long-term growth. This shift in mindset quietly affected every financial decision in his life: spending, saving, career choices, risk tolerance. Investing wasn't just building his account, it was building his identity. So here's a moment to pause again. Ask yourself something honestly. Not what you hope, not what sounds good, but the truth. If you started investing $5 a day today, where would you be in 10 years, in 20 years, in 30 years? Because the future version of you is quietly being built by the tiny decisions you make right now. Not the dramatic ones, the small, invisible ones.
And that's the real lesson of this story. We underestimate small actions, we underestimate patience, and we massively underestimate time. $5 a day sounds insignificant until you give it 3 decades. Then suddenly, it's not small anymore. It's life-changing. And the strangest part of all, the best time to start was 30 years ago. But the second best time might be today.